Hello and welcome back to Dukascopy TV. Now, we've seen PMI data today, along with numerous other releases in the Eurozone. Today I'm exploring what happens when two of Europe's biggest engines fail to provide the power expected of them. In this case, we're looking at France and Germany. On the line, I'm joined by Stephen Pope, Managing Partner at Spotlight Ideas in London. First of all, the PMI data out today from Germany and France, Stephen, and of course the wider Eurozone. Not as good as the markets were expecting, were they?
Yes, they were looking for better numbers than this. And I think at first there was some reaction that the French figure was an improvement on the prior reading. However, we have to respect that it is below 50 by quite some margin, around 6.5 points under 50. So it still is a signal of quite severe contraction in the manufacturing base within France. Now, if we go to Germany, it's barely above the baseline at 50.1, so pretty much a neutral reading there. It is disappointing because if the Eurozone growth story is going to continue showing any momentum in the course of this year, we really do need Germany to carry on being the full locomotive of growth.
Now, we know France and Germany tend to be the economic powerhouses when it comes to Europe's drive forward in growth. This reliance on these two countries can't continue if we're going to see waning figures such as the ones we've seen today, can it?
No, absolutely not. I think that Germany has, as you say, in the past been responsible for the majority of the heavy lifting. Now, we had a hiatus in the tension of the euro market when, well, we had in July President Draghi from the ECB saying he would do everything he had to, and then in September hinting that the OMT program, outright monetary transactions, was a possibility, and yields have descended to very low levels compared to where they were last summer. That, I think, has allowed a great deal of complacency to creep in. And what we're realizing now is that any optimism that was being seen from the PMI or business surveys was really down to overseas demand rather than domestic demand. Of course, if the euro were to go back and stay above 135, overseas demand is going to become increasingly hard to come by. At the moment, the euro has slipped back somewhat, but overall, I think that with Spain failing to make the monetary targets on its budget deficit reduction, with the Italian election over Sunday and Monday very much in the balance, we don't know how that will go, and still some question marks about the Spanish bribery situation at the top end of politics. There are many broken paving stones on the road forward for the Eurozone that we have to overcome. My worry is that those broken paving stones are actually just covering up one or two nasty potholes that we could easily slip into.
Let's focus on the markets for a moment. I imagine from your perspective you'll be searching for a haven today after this morning's PMI data, won't you?
Yes, I think at this current time, I believe that the equity market has overdone the downturn because the Fed may disagree upon the pace at which they withdraw and slow down QE, but nobody on the Federal Reserve Board is going to let the US economy crash into the buffer. So I think we've overreacted on the US downside. Europe is copying that movement. And again, if you look out for large cap companies who are able to source part of their value chain from outside of the Eurozone, they can overcome any currency difficulties there. So I think that there are buying opportunities on some of the inappropriately hit equities today. On the debt side, I think we're at the moment where we need to stay away from the periphery because, as I said earlier, we've become far too complacent. The spreads of Italy and Spain over the core do not represent the risks. With the Italian election over the weekend being potentially delivering a very weak left of centre coalition, or maybe Berlusconi creeps in somehow, but certainly a good chance of another election in 3 months' time. I think that being involved in the periphery is difficult, and also many investors are showing signs of being sated now and buying up this periphery debt. So I think that if you want to stay with the good quality fixed income, you've got to think about Germany. You still go with France because it's getting an easy ride at the current moment. And I think also UK as a European player is worthwhile because those are the markets that are large enough, liquid enough to give you some flexibility. Other things like Austria, Netherlands, Finland, they're nice markets, but they're just not big enough.
Just finally, Stephen, if you were picking a currency pair to trade in light of today's data and looking ahead, where would your attention be focused on right now?
I think I would overall be a seller of the euro against any particular pair at the current time. I would say I am a big favour of the US growth story, so I'd want to be long of dollar. So I think we will see better returns on euro-dollar if you are taking from the dollar side.
Thank you for joining me today, Stephen Pope from Spotlight Ideas. That's all for now. On Sunday and Monday, Italian elections will take centre stage, so don't forget to check back for our coverage of that. But for now, though, have a pleasant day. Goodbye.